The broadcast is now starting. All attendees are in listen-only mode.
And prestige. So that's really all I have for the industry. One very large company and then also one very small company, so we can figure how that plays in. All right. So I have to give back the screen now. Or is there any questions?
No.
Okay.
It should go to Tom. Somebody's sending the screen to me, but it should go to Tom. But I need to unmute Tom. Hold on a second.
I think I made it, Tom.
Okay, I've unmuted you, Tom.
Okay, now I think I'm unmuted. Can you hear me?
Yes.
Okay. So now is
you have to accept the.
Okay, I accepted it. So
there you go. We see it.
To take off on Prestige brand.
We can see your screen.
Okay. Is it okay? Does it need to be bigger or more centered or anything? Okay. Well, I chose Prestige brands, and when I found this, I was actually looking at a manifest webinar, and I thought this was a consumer staple, so that's why I went with it. But it turns out that the Morningstar, it's medical distribution. But they sell like Matt mentioned here, this company sells over-the-counter drugs, which I guess it's a medical distribution, but it's pretty much a staple as far as I'm concerned. And it says, to discuss why you consider this to be a high-quality growth company. I don't really know, but how it's a reasonable company. They've grown their sales consistently by developing new products, improving existing products, acquiring other companies, advertising and promotion.
Tom, can you speak a little louder? There's a lot of white noise.
Okay, I'm not quite sure.
Or just put the microphone. Oh, you don't have a microphone.
Well, I'm using my headset.
Just speak closer to the mic, maybe.
Is that better?
Yeah,
is that
that's
louder?
better. That's better.
Okay. So anyway, pre-tax profit and earnings have grown consistently, except during the recession, and then last year they wrote off some losses on divestitures. They have a fair amount of debt, but they're going to be paying it down for future acquisitions. And since this company has made a lot of acquisitions, I guess it's the goodwill on the balance sheet, and it's 15.7%, which is not huge. Some companies will have a lot more who make a lot of acquisitions. As far as the products they sell, they're not huge sellers. Things like chloroseptic, Ludens, BC powder, W, chloride, melamine, laxatives, monostat, CMD.
Tom, your voice is getting dying, so you need to speak a little bit louder.
Next, Debrox, Comet, Shortboy, Spick and Span. I don't know what else I can do here to make myself any louder other than I'm
that's a little better now. You need to invest in a new mic. That's what you need. Anyway, carry on.
Well, but you guys don't like it. I have a fan, and the
I see.
Fan, so
okay.
I can't do anything. So anyway, I project sales growth because that's the analysts were estimating 10%. So I cut it back a little bit, but the organic growth, like the products that they're selling, is only growing around 2 or 3%. So I guess they're going to have to make up that growth with acquisitions.
Do you just want to show us the SSG from this point on, and walk us through those numbers?
Well, let's let me go through here quickly. So then I used preferred procedure because let's see how it goes around. I'm going to get two things on the screen here at once now. Okay, so So, okay, so this is it. So I projected 8% growth, and then I used the preferred procedure, and that came out at 10.7%. Now, I did make an adjustment here for the tax rate, because, you know, they, with the new tax law, they projected that in the future they would be paying taxes at a 26% rate, and the historical has been 37.4. So I thought that was something reasonable to do. And I just, you know, I went with the average triangle PEs that are going out for last year as an outlier because they reported lower earnings, but the stock price stayed about the same, so that increased the EPS. And I chose 29 as the low price, which is, I guess that's maybe about 20% less than the current price, which, don't say it's really unreasonable. If I use the forecast low PE account, the forecast comes out lower than it comes out like $800 the current price. So it's kind of anyway. So, you know, I mean, on with the assumptions that I use is the return looks really good. You know, total return high PE could be 21 with the average PE could be 16.3. So this, provided this company grows at this rate, which is not guaranteed. As far as change, something here on the company's price went down recently, and they lowered their guidance a little bit. They have.
I have trouble hearing you, Tom.
Well, I'm. Should I? Well, I guess I could speak louder. Let me unplug this one here. Can you hear me better now?
Yes.
Actually, yes.
Okay. So they changed their EPS guidance. They did give a range of 258 to 268, but they cut it back to 258. They cut it back to the lower end. So when the stock went down on that, and they say they're facing increased margin pressure from increased freight rates, increased labor costs at their warehouses, and also retailer inventory reduction. And the one thing I made an adjustment to the data. Their GAAP results, so what the reports, the numbers reported to the SEC, they made $5.88 during the last quarter because of a one-time net or non-cash gain from the recognition of the deferred tax liabilities. It's kind of an accounting change, but that's what they have to legally report. But I put in the non-GAAP number, they adjusted for that. So really, the company made 70 cents, but since they recognized these deferred tax assets, it came out to 588, which is unrealistic. I guess I bought some of this stock myself when I did the study, and it's about what I paid for it, in the last couple of weeks. So it may have some potential. It's priced pretty low. It's a small cap company, which is something that we don't have too much of in the portfolio. But the results are not guaranteed. I don't. Unless they make acquisitions, I don't think they're going to be selling. Their products. They're not fast-growing products that they sell. It's just things that people buy day to day. But if the economy tanks or something like that, demand will probably still be there. People still need laxatives and headache remedies and lice shampoo. So I guess that's it, unless there's any questions.
So their future growth, you said their future growth, you think it was just from acquisition?
Well, that's what they'll have to do, I think, because their organic growth, from the products they're selling is 2 to 3%. But they'll have to make acquisitions to keep that growth rate at 8%.
So, okay. Also, I want to understand their business as well. So you say they sell healthcare products, cleaning products?
Well,
So can you?
they sell these products that are listed here on the screen, if you can see that. And they also sell Comet, Chore Boy, scrub things, and spick and span. So they have.
Oh, that's the product. Okay.
Oh,
that's a brand. Okay.
I want to, I looked this up. I did my own stock selection guide, and then I looked it up in Yahoo Finance, and there's a PEG ratio of 1.09, so it's a very low price. But more important, when I looked at the insider transactions, there's significant insider transactions buys by 3 or 4 corporate directors, and they're not buying by options, they're buying for cash. And you can look that up at Yahoo Finance under holders, but there's significant insider purchases in the last 6 months. And so I'm thinking I'm going to buy some of this myself.
Oh, Tom, thank you. Your fans finally stopped.
If the fan is running, you're just not hearing it.
Oh, now it's on. Oh, okay, now it's off. Now, yeah. Okay, so yeah, there's a guest also asked, can he turn off the fan? Anyway, okay, I see. So the small company, what's the sale of, can you show us the first page SSG again? How small is the company?
Less than $1 billion.
Oh, 800 million. Okay, 882 million. Okay.
Why do you think the price is down so much lately, Tom?
Well, the only thing I saw was, that they lowered their guidance a little bit, but they didn't lower it dramatically. That was the only thing I found. These small cap companies aren't covered by a lot of analysts, so sometimes it's a little hard to get information.
Yeah.
But that's the only negative information I found.
How much did they lower it? Do you know?
Well, it was not very much. The guidance was a range of 258 to 268, and they lowered it to 258. They just lowered it to the bottom end of the guidance.
Also, Tom, on the stock selection guide, I think you should cross out 2008 because it's negative. 2008, you should cross out that X 2008. Yeah.
Oh.
Yeah, see the number changes, the growth change a little bit.
The other thing, if you look at evaluating management, their pre-tax profit on sales has gone down quite a bit, about almost 25% from the 5-year average, and then the return on equity is going
down.
lower and lower.
Yeah.
And then very high debt to capital ratio.
Yeah.
Yeah. It doesn't it show it's all in the red?
Yeah.
Okay.
But sometimes, I mean, I look at the pattern of the last 5 years versus the 5-year average, because that tells you a little bit as well. So, I mean, it's in 2015 it was 19.5, and then 2016 it went down to 12.6. That's a pretty significant drop. I'm not sure why their profitability is taking a hit.
What? Tom, repeat that again. Why was there a dip on the earnings?
If you let me talk.
Okay.
The 2016 figure was a little bit of an outlier because they wrote off some divestitures. So I didn't adjust that for non-GAAP, but I mean they did. You can see that the sales line is flat with the pre-tax profit and earnings per share lines take a dip. It's because of that. So that's kind of an unusual event. I mean, it's still a business expense, but so that's why that one is so much lower. But they are saying that they're facing margin pressure because of the freight costs and the things I mentioned previously.
Let me say, because this is a learning group, and also because we have so many guests, the way Better Investing talks it for fairly new investors, 2A and 2B, if they're both down, that's a barbed wire point, and don't bother to go any further. If you're a more advanced investor, you could go ahead and climb over that fence. And because of Tom's background, I'm more willing to accept this. I looked at it for my other club, and because 2A and 2B were down, I discounted it. But if Tom thinks that they've actually overcome that, I'm willing to buy that, but only on faith of Tom, not because of the SSP.
Okay, I want to be clear, 2A, 2B for new members and the guests. 2A meaning the pre-tax profit on sales is the evaluation management, the bottom box, and the return equity is 2B. 2C is debt to capital. I just want, because on the online SSG doesn't say 2A, 2B, 2C. That's what Roy meant.
Farm on this because they're going to have to make acquisitions to grow at the rate that's projected, and that's certainly not guaranteed.
Okay.
But don't insider purchases, doesn't that mean anything? That must mean something. And I noticed the last year their earnings have popped back significantly, even faster than their sales.
Well, they had a one-time non-cash gain because they recognized some tax deferred things. So that's I changed that a little bit. So this is not a smooth, easy company to analyze.
Bernard, I have never heard us discuss under BI fundamentals the insider trading. So I don't know if it has significant influence on whether or not the stock is a good stock to invest in. I don't know. Roy, you might have
I think it's something that's worth looking at, because if management is buying a significant amount of shares, they usually know something that maybe the analysts don't. So it's a good indicator, but I wouldn't look at it in isolation. You have to take look at the whole picture as well.
In some of the training, Better Investing does recommend you at least look at it. The trouble is, let's say they were selling. Well, that in and of itself doesn't mean the company's bad. It could be that the officers or the directors that are selling do it regularly. They may have college bills for their kids to pay. Pay for their third home. It all depends on the situation. That's why it's not a leading indicator for buy or sell with the SSG, but Better Investing doesn't say ignore it, but be careful of it when you do look at it.
Okay, there's a question: how will they make these acquisitions with increasing debt and 2B, 2C is so wobbly, regardless of a gap?
I don't know how these guys are paying $10,000, $20,000 worth of stock, but some of these insiders are buying the stock directly, as I see in Yahoo Finance under insider information. So I don't know how they're paying for it. And you're right about, I noticed there's like 68% debt to capital. I don't like that, but those guys.
I think the only one way that they could finance new acquisitions would be to sell off parts of some of the brands that are maybe not performing very well. I don't think they can take on more debt. They'd have to issue more shares, which is going to be a dilutive effect. But but that may be, there may be some brands that are not doing well that they could sell off.
Hmm.
Is there a possibility they could be acquired?
You never know. It's possible. I don't know.
Possible.
But now you're entering Las Vegas territory. Are you betting on an acquisition or are you betting on the company? We look at whether the company is a sound company.
Yeah.
So let's take a look at another company, the competitor. Joanne, I make you presenter. Joanne, you're unmuted. Joanne, you're unmuted.
Sorry, I unmuted myself. Okay.
Yeah.
My company is McKesson Corporation, and they are a large company by BI definition. So they have, and then Roy was, when I completed my stock study, Roy was kind enough to give me the industry link to finding how to get the industry stats because I couldn't find that. So McKesson is doing above the industry average for performance for the historical sales and EPS. For a large company, I think they're doing really well. They're a huge company. They are, let's see, as of December 31st, they had 2.62 billion in cash and cash equivalents, and they've been spending their money on, let's see, they repaid 545 million in long-term debt, paid 2 billion for acquisitions, invested 392 million internally, and paid 192 million in dividends. And so what McKesson Corporation does, it's supply chain management solutions, does retail pharmacy, community oncology, and specialty care. And they have two main sectors. They do distribution solutions and technology solutions. And then I wanted just to bring up their website of what everything that they do. I mean, it's huge. So they do this. These are all the different things that McKesson is into. So blood bank, clinical trials. I mean, they're a huge company. So, but mainly what they do is doing the distribution solutions and the technology solutions. They have two main competitors, Cardinal Health and AmerisourceBergen. And this was kind of like a snapshot graph of what they've been around a long time. They were founded in 1833. This was 192 billion in revenues for 2017. So, and employ 75,000 people worldwide. So they're a huge company. Also, there was some concern about the new, I think it's Warren Buffett, was it Warren Buffett, Amazon, and some other company that were getting together to form a healthcare consortium to take care of their
JP Morgan.
But the threat, I mean, when they took a closer look, McKesson is so, the moat is so wide that it would take a long time for those companies to get to the point where McKesson is. So, let's see. And then there's also the concern about higher drug prices, but they would be passing those down the line. And so they'd maintain their same margins. Okay, so this is where I guess I can switch to my SSG because this is where I get to where my estimates are. So, another thing is I wanted to talk about when we were doing the GAAP versus non-GAAP. I based my estimates on the SSG. And then Tom, when I shared my SSG study with Tom, he's much more savvy with the non-GAAP, and he did some exploration, and we'll take a second look at what his SSG looked like. So originally I estimated a 7% forecast for the historical sales. I compared against let me just click back here. So Yahoo, Zacks, BI, they were all in the 3%. Value Line had 7.5%, and the guidance in the latest conference call was McKesson Management said it was mid-single digits. So I selected 7% for sales growth. And then here's what's interesting. Originally, I think I had it around 7 or 11% for the EPS, and Tom said, well, your 5-year estimate is way over what the well, because when I clicked on estimating the historical EPS, it was in the negative. So I said, and I've never used a negative number for EPS. So, but if I used the positive number, it was way out of line with the Value Line estimate. So I went ahead and I used the negative number, and I just plugged. I used a preferred procedure, and under the guidance from the last quarter, I adjusted the taxes. And so,
Joanne, could you just go if you could go back to the preferred procedure
yes,
for a second? Sorry. On the right-hand side, you have the shares, diluted shares outstanding. If you could click on that, please. So, so we're using 208. Do you know if Value Line is projecting 5 years out? Because that's what this is, I guess. If they're buying back shares, because if you lower the number of shares, your EPS is going to go up a little bit.
Yeah, I did do. I looked at. So Value Line has like a calculation that you can use for the diluted shares, and they say to. So when I did it, it came out to 204. But let's see what happens with that. Oh, it didn't change it. It made it 0.3.
You have to update.
Oh, update it up here. Oh.
Yeah.
But didn't that
click the update button.
Oh, okay.
Update study button. Yeah.
Okay. So it changed. Oh,
And
I
then
see. It puts it into the positive. I see. Okay. But see that, but that 22. So the Value Line 5-year estimate was 2050.
Okay.
Let me correct that. It
Okay.
is not a 5-year estimate. It's a 3 to 5 year.
3 to 5 year. Okay.
And
thank you.
that's why often people say, well, let's just set a 4-year. The SSG goes out 5 years. So I wouldn't.
So this could be.
So like if your numbers were double, that would be, I think, a little rash. But
Okay.
if it's a little bit above Value Line, that to me meets the 4 to 5 year dichotomy.
Okay. Thank you. Good point.
So now, it looks to me, just looking at the graph, 2016 looks like an outlier because I mean the sales are flat, but the earnings are shoot up and then they go back down. So
Which one? Which year?
2016.
2016. It looks like an outlier.
This one. Okay.
Yeah, mine's
the other data source.
Okay. All right.
Yeah, it looks like the fourth quarter will kind of come in line a little bit higher with 2015, right? So it looks like if you extend that line from 2012 to 2015, that's kind of where the earnings will end up.
So what would I do?
Oh, I'm just visual. I mean, I don't know if you can.
Does that do anything?
So what happened to 2016? Why is 2016 the outlier?
They had okay, so I have my
acquisition something you said?
No, they had let's see. High PE fell dramatically in 2016 as earnings per share more than doubled due to a $2 billion share repurchase program.
Okay, got it. I see. Okay.
See, and that was probably a one-time thing. So that's where you would make an adjustment.
Okay. So we will come back to that because that's exactly what. Okay, so this is something new that I learned from Tom and Roy is about using the non-GAAP numbers. But because right now I just use what was in the BI, but Roy and Tom are more. Well, Tom says it's because they used to do everything by hand, and he knows where to get the numbers. So, okay. So then when I came to estimate the high price, I used, I think it was 2.5 times the sales. So I get 2.5 times the sales times the the high EPS forecast.
Joanne, I noticed you removed a couple of the PE outliers, that 8 and 4.9. If you take out the 32 and the 30, what does
Oh, up
that
here?
do?
And the 8 and the low one?
And the 30.9. Yeah, you had the 8.6.
Take that one out too?
And then the 4.9 on the low side, below PE. Yeah. So that gives you average of 19, and the current is 6.8. Okay.
Okay. So, and this is another thing that Jay taught me, is that when this current PE ratio is lower than the average price earnings ratio, then you have room for expansion. So that's a positive indicator. And then for selected,
This is so, usually it's pretty close, but this 6.8
is way out of whack.
wait, yeah, I was like, wow, what's wrong?
Okay, and then
I can show you why after.
Okay, you tell me what. Okay, and then for low price, I picked the 114.5, the recent market low price, and that puts us in a buy. So,
what's the current price? What's the 52 weeks low?
52 is 133.82.
Okay. Okay.
And it was higher, but it did drop. Oh, this isn't the. Let me update the price. Oh, it popped back up. Okay. So it's 150.50 now. But the high was 178.86. So it's been kind of, buffeted around because of all the, when Amazon, JP Morgan, and is it Warren Buffett? I can't remember who the combination was. When they came out with their announcement, this stock really took a hit, but then it popped back up after the assessment. And then also recently, I believe Canada did something about their pricing on generic drugs. I think there's going to be more regulations. So McKesson took another hit, but they don't have, they have interests in generic, but it's not enough to cause a big, a detriment to their company. So they're, yes.
Do you happen to know how much the restricted drugs are that they sell? Like codeine or
in Canada,
Oxy and that. No, the McKesson, because if they don't have any, then there would be subject to competition. But if they have a substantial foothold there, it's hard for somebody new to come in and get approval from the FDA to sell those drugs. So I take all that with a grain of salt.
I would assume, Roy, though, that because when on the slide that Joanne showed, that summary slide that was taken from, I think, Seeking Alpha, it said that they 1/3 of all prescription medicine in North America. So they must have pretty significant.
But there's prescription medicine that I take that's not regulated heavily. Some you have to have the doctor's signature, actually, the hard copy before they fill it. Others you can do it electronically. So
yeah, no, I'm just saying, if they're handling 1/3 of all prescriptions in North America, then a good percentage of those might be restricted drugs, as you were saying.
Yeah, but I think more the regulatory part about with Canada is for generic drugs, so that they don't jack up the price. So it's not specifically about you know,
Yeah, no,
high.
I wasn't speaking of Canada. I was speaking about this so-called competition by
Oh, I
Buffett.
see. Yeah,
Hey,
yeah. Oh, I see.
I think it's smoke and mirrors myself, but I could be
Oh,
wrong.
okay. I have a question about this company with the question, the MCK. Well, I forgot the name of it. Tom
McKesson.
presented.
McKesson.
McKesson. So I understand it's called. We talked about this in the past about the competitors. So you may have a trouble to find direct competitors, but I don't think this company is a medical distribution.
Yeah,
So,
I know. That's the whole thing is that I don't know why or how Morningstar does its categories. I mean, when Tom and I were looking at companies to evaluate, he was looking at value line categories, and we've got companies in two different. I said, but we need to use Morningstar because that's how we manage our portfolio. So I don't know why.
They're a drug distributor. They don't manufacture drugs. I mean, what else would they be?
Yeah.
So
I think CVS would be a good competitor to this company. They kind of do the same thing.
These people are wholesale. They have really slim margins.
okay. So in their 10K, did they mention any of the competitors?
Well, there's nobody that does exactly what they do, but their immediate competitors are these Cardinal
that
Health,
Amerisource
Bergen.
Iogen or whatever.
Okay.
Yeah, Bergen. That's
Yeah.
one.
No, what about for Tom's that supply medical cleaning products one? Who are their competitors? Direct competitors, if you ever
You know,
looked.
I didn't happen to see any. I looked, the peers on the peer company on Better Investing was somebody I never heard of.
Mm.
Okay, so you know what? Just for the sake of time, because
Yeah, I'm
we're
just
going
curious.
over,
I just felt like they did
I want
different
to bring
things.
up Tom's study.
Mm-hmm.
So Tom
Okay.
went in and he used those non-GAAP numbers, and he
I used value line data.
yeah,
and
value line did. And
just
where
about
did you
like
go? Did you go to annual data or
No, I
quarterly?
just went to the value line report and put in the value line earnings per share
But
figure.
where did you put it in? Quarterly
And,
data or
and
annual?
both quarterly, the last 4 or 5 quarters, plus every year for the past 10 years.
So you changed to here? Can you see the
Yes.
screen, Tom?
Yeah.
Well, I guess I don't know what you pulled up, but the one I sent you used. Maybe I just sent it in Toolkit.
Oh, you
That's
did it in
correct.
Toolkit. Okay, you did
That's
it in Toolkit.
correct.
Wait, stop. Go back to data again to the annual.
Annual, okay.
And you see in the next to the last column, it's the use. That shows it's user modified data. So this is the one that Tom modified.
Okay, thank you, Roy. Okay, so he went and he modified this EPS, earnings per share, based on value line data. And then you'll see, so that, remember, was it 23 that was in 2016? It changes to 1161. But it also changes the debt to capital, and I'm not exactly sure why that happens. So Tom used a lower sales forecast, and then I think Tom uses 5 as the EPS growth as earnings following sales, so that, because this wasn't my study. This Tom just said, I'm going to do a quick SSG just to show you what. So he picked more conservative numbers.
So what was the outcome? Is still a buy or no? Oh.
And then he used 20.6, but let's use, what did we have before? 17 and a half. So it's still on a buy.
Right. What's the also change the low price?
Oh,
matches 120. Actually, 120 is not bad. 130.
Yeah, he used 80% of the
okay.
He used 80%
That's
of
fine, I think.
the low.
Yeah, I think it's fine. To me.
Okay. Yeah.
So they do pay dividends.
Yes.
Okay. So still give you 14%. Okay.
Yeah.
Okay.
But
So,
Value Line has a return of, let's see, I have it on here.
so
Value Line has a projected return of 17 to 26%. But with Tom's, it comes out 11 to 14, which is, conservative.
Okay. So
I think because of the earnings, because Tom put a 5% earnings growth rate, and Joanne, you had a lower
3%.
number using the preferred procedure.
So this is a little bit off the subject, but I noticed that some medical companies have been lobbying and paying money to keep marijuana illegal. And but on the other hand, some medical companies are looking into marijuana. Did any of that come up in your studies?
No, I didn't see anything on.
In Canada, it's now legal, medicinal, and in July it will be recreationally. It will be legalized as well.
Nationally,
and,
or just?
Is it national? Yeah, I think national.
Because we just have it by state in the U.S.
No, it's national.
Okay.
National. And if you look at marijuana stocks in Canada, it's like Bitcoin. They've been going crazy. But if you look at the fundamentals of those companies, there's no historical data, so
yeah,
it's pretty risky. But anyways,
thank you.
okay, so let's move on. We will vote after we present.
Jay, could I have like 2 seconds just to show something?
2 seconds about the current PE.
If
ratio.
you can give me control for just 1 second.
Okay.
I did a quick couple of price charts.
Do you want me to do it?
So,
I already did.
Okay, you did. Thank you, Jay.
Sure.
okay, so
Accept.
You have to accept
Yes.
it, Annie.
yeah.
There you go.
Okay, so this is why stock charts, and what I did was I did a the first symbol there, the $GSPHC, is the S&P 500 Healthcare Equipment and Services Index, and then I put both PBH and MCK against that just to see how the stock has performed over the last 200 days, and you could see. I know they're not direct competitors, but you could see McKesson is 5% total return, I guess, over that time period, whereas the index is more like maybe 18 here, and PBH is way down. And then if you if I look at the this is the McKesson stock chart. What I did was I went to Yahoo Finance, downloaded the last year's prices, took the average, and the average price over the past year is about 152. And so the current price is more or less, it's about 1% less than the average price for the last year. For PBH, it's minus 29. So it's way. I'll just put that up real quick. PBH. You could see it's like taken quite a drastic drop. Yeah. So I know we don't use this very much, but it's just one time we can do a educational topic on these moving averages, because it tells you a little bit of maybe when it is a good time to buy. But this, I think, tells a bit of a story here, the relative returns. So
Great.
that's all I wanted.
Okay.
Would you say it's a washout or a buy or bargain?
Well, the thing is, I guess it depends, because for the long term, maybe depending on, and this is where we have to check the story of Prestige Brands and McKesson, is what will cause those prices to go back up? What's the driving force? How are they going to increase sales and profitability? And that kind of information you can only get from their earnings calls or annual reports. So That's where I would kind of do a bit more detective work.
Okay.
If I could, if you look at the green line, and around mid-October, you see a big fall. All of biotech took a big fall then. In another club, we own some, and it's very, very frustrating trying to figure all this out because it's gone down, but then it went up, and now it's down again. Well, we've had a bad February. So this is this shows the difference between stuff that's industry specific versus an average. I mean, S&P only has a small portion devoted to healthcare. So I think it's good in comparison, but this just shows if other companies in this area, they all took that dump in mid-October. Very frustrating, but I'm impressed that McKesson grew quite a bit between then until late January when the market turned down again. So
yep.
Okay. So all right, and then let's hold on our motion to until the later when we vote on the stocks. Thank you, Henny. Tom, let's move on to our annual report. Biogen. Tom, do you want to present or show your screen, or do you want me to do it? Okay, so go ahead, Tom. You unmute yourself. You're muted. Can you walk us through Biogen? Oh, okay. First of all, I want to say, so we have changed our annual report summary form from our previous form. We felt that the previous form have a lot of questions. Is not very that critical or important. So Roy took initiative and created a new one. And this is the first time we use this form. So we are still learning. And before the meeting, and then Joy and I and Tom Roy, we had a discussion about, okay, maybe one of you can explain to us, educate us again, remind us again that the GAAP and non-GAAP, and also which one should we really look at it. And for presenters, you may just walk us through the summary of your annual report, and then we will ask the questions if we have any. Then we show your stock selection guide. As annual report, we must do a new SSG. Go ahead, Tom.
Okay, so for Biogen, for the last quarter, they reported, officially for the GAAP number, they reported a loss of $1.40, but that had to do with the new tax bill. So they said that their non-GAAP number was $5.26. So I did my SSG substituting that number in there. Also for the year, they added back some charges for a Tecfidera litigation settlement, and also a payment to something called Neuroimmune for hopefully to get more profits in the future. So they're doing some accounting changes, I guess, to make themselves look a little bit better. But the tax change they couldn't do anything about, but I think the other one is sort of playing with the numbers. The price when I did the study was $328, and now it's down about 11% since I did it a couple weeks ago. And if you can go down to the bottom, okay. They have this new spinal cord. I forget what it's called, but anyway, this new drug for spinal muscle atrophy, I guess. It's driving the sales growth right now, but serious competition is expected from a drug possibly as early as next year. This drug only requires a single dose, where Spinraza needs to be administered on an ongoing basis. So if it works as well as the Spinraza, it'll have a big advantage there. They have this clinical trial failure. They tried to add an indication for acute ischemic stroke for this MS drug Tysabri. That study failed, and they're not planning on following through that. But I think the big news was they pushed back the date for this aducanumab, the Alzheimer's drug. Is not expected until 2020. They were expecting it in 2019. And they say they're getting variable results from the data. So they added some more patients. And to me, variable results means that, they're probably not getting as many positive results as they would like. So I think there's the confidence. I don't think the company has as much confidence that the drug is going to be effective. And so, that day the price fell 8% to stop. And this one analyst or one service, Argus, downgraded it from a buy to hold. So, the numbers on the SSG come out pretty good, but, with all these news from the company, I can't really recommend repurchasing more. And so, I projected the 6% sales growth. I cut that back a little bit from what we had. And then I did the preferred procedure. So I click on that. I changed the tax rate down to 24% because that's what they say their taxes are going to be in the future. But that's more like it's still 2017. They really paid a high tax rate. And I cut the shares back to 200 million. That was the value line estimate for the 3 to 5 year share count. And that's why the sales growth or the earnings growth is larger than the sales growth. And I guess I just
Oh, sorry, the bottom part, I forgot, show the management, even up.
Oh, management. Okay, I guess, pre-tax profit on sales is even, return on equity is up, and debt to capital is, I guess they for the last 3 years it's been a lot higher. Well, I guess they must have made an acquisition or something. They're borrowing money to buy back shares, and they're getting it way up.
Okay. All right. Second page.
So I guess I selected. Can't remember why. I guess
IP20.
this one was a forecast low price. Maybe that's too high. It's higher than the low this year. Maybe I should have cut that back some.
So even though it's a buy, your final recommendation is a hold?
Given, I think, their MS drugs, I didn't highlight that sentence, their MS drugs are facing increased competition. Spinraza is probably going to have more competition. The aducanumab is looking shakier. So, as far as the fundamental news, I can't really, I don't see anything positive really. Even though the price looks decent, maybe, I don't know why the analysts are predicting 7% growth. That's, I sort of went with their recommendations. I can't, maybe I should have cut it back or something, but it doesn't seem like a positive story to me at this point. Maybe in the future it will seem more positive, but right now I'm not positive on it.
Okay. So any questions for Tom on Biogen? No questions. Okay, thank you, Tom. So Matt, IPGP, I'm making you a presenter.
Okay.
Okay.
So IPGP, so they just reported earnings on Friday. So these are all pretty preliminary. Everything I did came off the press release and the consolidated statements. So it hasn't been loaded into Morningstar and then BetterInvesting as of yet. But anyways, with that caveat, so they had a good year. The guidance, the stock actually dropped about 7% after they released earnings. They didn't give any earnings forecast, but for the SSG, I'm going to use 17.5 just because I think they've been pretty consistently beating to the high end of their guidance for the last 2 years or so.
Somebody.
Matt, you kind of cut out.
Oops, sorry. Sorry about that. Hit the mute button on accident. So yeah, I used the higher end of the sales and the earnings because they pretty consistently beat their own guidance the last couple of years. Moving on, so the current price $239. I think it's still a hold, I guess, getting down to the end. It's a sell above 250 with the preliminary numbers I updated. So sales growth for last year was 40%. They're projecting 15% for the coming year. I had 25% in there before for sales growth, so I'm going to back that down to 15.
Why is that?
Because that's what they're guiding for.
Oh, okay.
So I think I kind of wait and see, just to see how the first quarter ends up, because they're guiding the first quarter higher than their full year guidance. So it seems like they're expecting some slower sales in the second half of the year, and we'll probably just get a little bit more information as the year goes on about that. Is my guess. Anyways, that's a guess as of this moment. Okay, so earnings, historic 10 years, 27% is really good. So 17.5, they'd actually be below their historical earnings. 1 year for the quarter was -30, but that was because the money they're bringing back from overseas, so they're paying the repatriation tax. If you didn't count that one-time tax, they'd actually have 35% 1 year earnings growth, which is really great. Projected, like I said, I'm using 17.5%. Just because their earnings, they've been talking about they're having a shift towards a different mix that's a little bit higher margin, so their earnings should outperform their sales growth a little bit. That was also 25% for last SSG, so I backed that off a little bit as well. Pre-tax profit margin, 41%, which was up from 38% prior. Return on equity is 19%, which is flat, and then debt to equity is at 2%, also flat. I guess the biggest thing here from the 10K, they have a ton of cash. So they have like almost $1 billion in cash, maybe a little bit more. For a company their size, it's a ton. It's basically 1/12 of their value is just in cash alone. So they're probably going to do something with it. I don't know what yet, but just sitting on that kind of crazy for a company their size. So maybe mergers, maybe dividend, like we kind of talked about down here, or share repurchases, or things like that. So definitely a lot of positive things for IPGP. I'm going to say a hold for now, so we kind of get a little bit more clarity on the rest of this year.
Okay, can you show us the SSG, please?
Yeah, I think I had it here. Oops, sorry, this is it here. I did put the estimates, the non-GAAP estimates in there for the quarterly data. So I'll just skip right to the valuation. So you can see it's a hold. Sorry, it's a hold till about 255. So it's been in that range. That's about right where it was right before they released earnings, and then it dropped with the decreased guidance.
Matt, could you just go up a little bit where the PEs are? I just want to have a quick look.
Oh, sure. There you
go. Okay.
Pretty consistent.
Yeah, very consistent.
Yeah, so high PE, 23. So I just used the average, even though they're at a 33 right now. And then the low is a 16.
So
what's
Jay,
the sales of the, yes.
What do you think of that 33 current price earnings compared to the average of 19? I mean, that's a big spread, right?
That's
Yeah.
why it's a hold, I think.
Okay.
Yeah. Also, what's the size of the company? How much? What's their sales number? What size of the company?
Sales,
Well, it was a small, right, when
uh,
we bought it on the first page.
yeah, sorry.
Okay. So can you go down sales? Okay, okay, just a little over. So
Yeah, they're
it's
a little
it's
over $1
just
billion.
become a medium-sized company, right? So 1 billion. Wait, is that right?
Yeah.
Yeah. Okay.
Mhm.
So still have
I think it's like 1.2 this year.
right 1.6 sale. Okay. Okay. So it's a hold. This is the star, our star stock in our portfolio, IPGP.
But now it's kind of flattening.
Yeah, I think everybody's kind of wait and see. They've done really good because most of their growth is in China, selling lasers to cell phone manufacturers and electronics parts manufacturers. So we'll see,
Yeah.
I guess. I think.
Yeah,
I'm not sure that it's flattening. What it is, you can see the price jump. It's just the price has gotten ahead of its earnings, but it's
right.
no, it's not slowing down. If so, not by much. It's just that it's really a hot stock at the moment.
Right. Yeah. Can you click on the quarter instead of trend on the projection starting point? First page. I want to see
Sorry.
it. Yeah, quarter.
This part?
Yes. I was, yeah. Yeah, let's
So
hold. Yeah, go ahead, Penny.
I would say that if we should watch this, and then if there's a pullback in price, maybe that would be a good opportunity to buy some more, because it seems to be doing really well, and I think they still have a ways to go, given that they're only $1 billion in sales.
Yeah, I think so. Let's just wait and see watch quarter by quarter. Okay, great. Thank you so much, Matt.
Right.
Okay, all right. Any questions for Matt? Okay, no questions. I'm going to make a Jane presenter on Facebook. Jane? Is Jane muted? Jane, you are muted. Okay, there you go. Yeah. You need to, okay, there you go. Okay. So what's going on with Facebook? You may just summarize to us, and we probably don't have time to go in detail. Just tell us how they do this year. Any news, bad news, good news?
Okay. In that case, should I show you the fourth quarter report? Maybe easier to see, or whatever. Okay, we'll start with the annual stock evaluation. Basically, the sales and the earnings per share, specifically on in the fourth quarter, the EPS, it was reported that 1.44 per share EPS per share. It's 1.44 for the fourth quarter, but in that amount, actually there was a $0.77 for the non-recurring tax charge. So if we add that back, that will give us a growth rate of 47.3% for the fourth quarter. And it's not exactly because in the last year, fourth quarter, the same EPS because of that non-recurring tax charge. So I add that back to get the fourth quarter amount. And that's why we still see a growth in the fourth quarter. And however, there's no guidance provided for the annual 10K. And however, the management did reported that the growth rate of the company have been decelerating because they are investing a lot in technology, infrastructure, security to just keep the platform safe and sound. And I have seen, although the financial effect of all these investments have not been reflected in the 10K that we are looking at this time, I still feel the management is really looking at the long-term prospect of the company and is really investing. And I really like the vision of the company. They are trying not to make the connection of the company, of the platform to be fun, but they also make it more meaningful and more secure and sound. So they are investing a lot, and they are investing a lot in the technology, the AR. So if you look at the fourth quarter stock evaluation, I have prepared. They have invested a lot on the artificial intelligence and AR, VR, and I feel that the company has a very healthy balance sheet, and they have outstanding A++ financial strength, and however, we have been purchasing this stock twice, one time in $152 around that, and the other time around $179. So the average purchase price, the cost for us is about $166. So now the price is sitting at $173, and no, actually it's $177 last Friday. And I feel the SSG, if you look at SSG, if you look at SSG, I prepare the historical growth. The historical is 52, but I'm trying to be more conservative, so I take 28 as a growth rate for the sales. And for the earnings per share, I use a preferred procedure, so I get 26.4. And but with that, remember I mentioned in the fourth quarter, I make a adjustment to the fourth quarter because of the non-recurring tax charge. So actually the fourth quarter is now 1.44, now it's 2.12. So the total for the year is 6.16. That's why if I make that change, then that is reflected in the earning per share growth rate. So I use 26.4 in fact, but if I adjusted that annual amount, then you will see a higher EPS growth rate I use. I actually use 26.4. But with that projection, I'm being very conservative. So I took out a lot of high PE and low PE years for the last 3 years. And so I still get a buy of 5.8 to 1. And so the annual return on the average PE is 19.1. So my recommendation is that depending on how much we want to invest in this company, because we already have 2 positions in this company, and if we still feel that this is a viable company, it has a long-term prospect, which I think it does, and the current price is still relatively reasonable. It's not high. It's $173, and with the annual return of 19.1 on the average PE, on the high PE will be 23.8. But I think this company has great potential, and the financial performance is not reflecting all the investments they have been making since last year. And I feel the company has a great vision, and the management is really wonderful. The balance sheet is perfect. So I just feel it's a company to consider if we want to have a bigger position.
Do they talk about artificial intelligence in that area? So how does artificial intelligence going to help with Facebook?
I think they are using a lot of robots to detect all the comments.
Okay.
Yeah. So
Got
they
it.
are in the past, yeah. So they are using all technology to detect all these unfavorable comments.
Okay.
So they are doing a lot of things, and there's a lot to look forward to. And one time I did actually the first time I presented this in the quarterly report, I did not recommend buy because I was concerned the investment may not play out. But then the I felt, it's about time to look into. And this time, the price is even lower than the last time.
Mm-hmm. Yeah.
I think the other thing I read, Jay, was also that they're using the AI to match advertising, and that's going to be a huge, I think, revenue growth area for them.
What does that mean? Use the AI to match advertising?
So basically, they look at like patterns of what you're
what are you looking for? What are you shopping?
Yeah, and or things things in your profile, and then they match that with advertising. So, and that I agree with Jane that a lot of this stuff is very sort of nebulous, and people have not reflected some of these investments in the price because nobody really knows what they're doing. There's a lot of R&D going on, a lot of investment, but it's not exactly clear. But based on past performance, I think they're gonna some of these things are gonna pay huge dividends.
Okay. Yeah.
Amen. So thank you, Jane and Haney. I just want to mention on the bad side, I noticed that George Soros sold all of his Facebook. Now he's a pretty smart investor. Now I'm keeping mine, but that's on the negative. On the plus side, the history, they have a way of monetizing things. Mark Zuckerberg has a history that you won't find very many places. And it's a very good company. And I've been impressed. I've been watching them on C-SPAN. I'm impressed with some of the people that they have representing them around the world. They have some very smart people. So there are a lot of things I like, but okay, never mind. Go ahead. That was very good, Jane. Thank you.
Right. Thank you, Jane. So any other questions for Jane before we move on? Okay, great. Thank you, Jane. All right, next quarter report, Disney. Andrew, are you ready? I'll make you a presenter.
Okay, sounds good.
Okay, accept. Okay.
Okay, perfect. So I'll go through it fairly quickly just for the sake of time, but essentially nothing very significant in terms of any sales or EPS growth projections. In terms of the recent quarter and trailing 4-quarter data, all fairly positive. Again, only negative is the year-over-year pre-tax profit percent change for the trailing 4 quarters. I don't know if we want to discuss that later, but in terms of the current value of the stock, when I basically we tried to keep everything fairly similar because I was informed that we only do SSGs for the 10K and not for quarterly. But currently, based on what the data showed in the SSG, the current PE ratio is 14.9, with the average PE on SSG being 18.3, having a relative value of less than 1, so 0.81, which was lower than what it was in the previous report, suggesting that currently it may be undervalued as it previously was above 1 for the annual report. It was above 1, so suggesting it may be cheaper right now. And then in terms of any additional information, just going through the Seeking Alpha transcript, a lot of positives. So the Fox deal, as most of you probably know, is on the verge of completion as it awaits regulatory approval. Lots of positive growth in operating income in several parts of the company, mainly Disneyland Paris, resulting in 21% growth. Disney Cruise Line, Disney Vacation Club, increasing operating income. EPS for the first fiscal quarter was up 22% at $1.89, which is 28 cents higher than projected. So a lot of positive signs overall. So, and then in terms of any new judgment for numbers for the SSG, based on what Value Line was showing, Value Line was projecting 6% sales growth for the next 5 years and 8.5% EPS growth. So I had done an SSG using those numbers, and it resulted in a 3.6 to 1 upside downside ratio, suggesting a buy. And then Value Line also showed revenue numbers and EPS in the next 5 years. So based on how to get those numbers, BI required sales growth of 3% and 4% for EPS, so much more conservative than what Value Line was suggesting. And even when that was plugged in to the SSG, it still resulted in an upside downside ratio of 2.3 to 1, which was a buy looking at the 33% view, or a verge onto a hold when looking at 25, 50, 25. So overall, fairly, in my opinion, I thought it was a fairly healthy company, and fortunately, it seems to be cheaper than what it was at the end of the previous fiscal year. And as a result, it come to the conclusion of a buy.
Okay, so is that conclusion for SSG's buy? What's your final recommendation? Do you recommend the club to buy more? If it is, you have SSG, maybe you can show us.
Sure. So the SSG itself, I only was able to post the one, but this was the SSG that I had done with the 6% growth in sales and 8.5% EPS. I can just
you don't have the ITK. You don't have the.
Oh, I do have it as well. Sure. Yes. Let me see if I can.
Okay.
Let's see.
You have to log in.
I think I have it in my in the Google Drive.
Okay. Oh. In your Google Drive.
Should be here.
It won't click because it's a tool.
Oh, it won't.
I'm sorry.
Well, I think she wants to see the live one, Andrew.
I will see the live one.
Oh, like log into BetterInvesting itself.
Yes. Yes.
Oh, okay.
Do you have it? Yeah. Do you have it?
Yeah, I can open it up real quick.
Okay. Yeah. If you don't, I already imported.
Okay. Sure, I can log in real quick.
Okay.
And I have a question about return. If our goal is 15% or above the market, is that right for return?
15%, yes, or depending on where the market is, maybe like 5% above, something like that.
So if it doesn't hit that, even if it's in a buy, would we consider that to be a potential challenger? I mean, that we could challenge it?
That's always the case, but we say 15%. Like Haney said, it's really 5% above whatever the market is, and if the market's 8, then 13 makes our 5%. But that's our portfolio. So, like if you have a large company, let's say we bought McKesson and it was say a 12.
Right.
That the fact that it wasn't a 15 wouldn't say we get pass on it, because maybe some of our other ones like IPGP was giving us 20%. So the 15% is supposedly the portfolio average when the market is at 10%. Well, if the market at 25%, 15 is pretty bad.
Oh, so I see. Okay.
It's a moving target, unfortunately.
Right. Okay.
Yeah, I think also you want to have a mix of companies. So Disney or Facebook, very solid companies, very strong balance sheets, good brands going forward. So if they don't grow as much as say an IPGP, that's okay, because in the portfolio you want to balance out some fast growers with some solid, steady sort of dividend paying companies. So
got it.
Okay, so 6 and 8.5. Okay, can you show us the second page?
Sure.
Valuation and return.
So I took out the 2015 high just because it seemed a little bit out of place compared to the relative everything else. But this
is pretty consistent as well. Okay. Okay, so later on somebody can make a motion whether buy more or not. Okay. Okay. Any other questions for Andrew on Disney?
I just want to comment that it seems the sales are kind of flat.
It's a large mega company. Can you go to the first page, Andrew? Sales? Yeah, it is. 55 billion.
And if I remember correctly, I do believe the CEO did talk a little bit about that in the Seeking Alpha transcript. Let me see if I can
You just summarize for us if what you can remember.
Well, essentially, most of the sales have been a little bit stagnant or offset, but overall, there has been some fairly steady growth in the overall, I'll say, huge big picture. Certain platforms have been seeing more growth, like I said, Disneyland Paris, Disney's Cruise Line. So it kind of is relative based on what I guess I'll say is trending now currently. Again, also with the Fox I'll say merger for lack of a better term. A lot of
yes, it is.
Okay, perfect. So the merger with Fox has also been seeing a lot of positive growth, especially with things such as ESPN. The ESPN app is supposed to have a complete redesign, which is completely personalized to the user, and Disney is hoping that will also start to increase viewings and streaming that wasn't accessible to them before through the news and sports sector. But overall, just I guess in terms of personal opinion, all of the numbers that I threw into the SSG, both conservative and more aggressive for Disney, seem to be having the same underlying message that they're growing steadily and they're currently fairly undervalued relative to what they were at previously.
And I don't think long term the streaming service that they're planning on launching is kind of being reflected in the price either. I think that might give them a bit of a boost on the sales side.
That's also a very good point as well. Yeah, because that's the other thing too. Unfortunately, the numbers that we had used in the SSG were the 2017 Q4 numbers because the Q1 for 2018 hadn't been released yet on Better Investing. So there was a little bit of a delay in terms of those numbers, but even in reflecting with what was displayed in the call, everything's still to kind of line up in terms of current day.
So as tonight Tom showed, you don't have to wait. If the data has not pushed out to Better Investing, you can manually add them based on the earnings. Yeah, just for your future reference.
Okay. That's good to know.
Okay, great. Okay, thank you.
The only concern I had with that, Jay, and and maybe Tom can is are those numbers manipulated in any way when they put them in? Like, so are we comparing apples to apples?
What do you mean manipulate? The numbers,
well, especially on the pre-tax profit, not so much on the sales and earnings, but pre-tax profit, and it's usually not reported, and so if you want to compare that, it's
actually it is reported. It's the net profit before taxes. So you can find it on the financial pages of the 10K and 10Q.
You can compare that pre-tax profit number from 2016 just to see, on the Better Investing, just to compare that data from the financial report, just see if it matches. Then you will know if they made any changes or not. I'm sure it was, yeah. Okay. All right. So thank you, Andrew. Last one is Skyworks. So I make Roy a presenter.
Okay.
Skyworks.
First, I just wanted to touch base. We skipped over this in the treasurer's report. This is from the iClub, my iClub tool. And as you can see here, there's some errors. That's why I didn't want to really report it. But what I wanted to show, this breaks it down, not just small, mid, and large, but also mega and micro. And Disney is so huge, they consider it a mega company. And here's our size, and this is by sales, not by the sales growth. So this is, if you compared this with the more manifest investing chart we saw, it would look quite different. But this is using BI's theory. So I just wanted to show that.
Okay, great.
Let's see here.
Where was Disney on it? Where was Disney on that chart?
It was a mega. It's a huge company.
Oh, okay.
Okay, let me go now to the quarterly valuation. And because I had so much to write, it changed the
That's
formatting.
Okay. Yeah.
But anyway, so here I am. And it's fairly straightforward till you get down to this earnings growth, and it showed a negative 72.5. And if you compare it with the pre-tax profit, they should be fairly similar. And that's, what happened. So I dug into all the resources I could and discovered what it was. They took a one-time charge on taxes. And it's a one-time because of the Tax Act. They're going to look much better in taxes, but they did take it in the last quarter. So if you look at the GAAP numbers, it looks really bad. But when you take that out, add back in what they charged for taxes, they had almost a 45% recent quarter and 27 on the trailing 4 quarters. So, and that also, by doing that, changed the relative value from 140% down to 102. So it's pretty much the value is what the actual stock price is. And this at the bottom of my page is where I have the explanation for that. So if you'd like, if there's any questions, I can answer them. Otherwise, I'll go to the SSG because I know we're running out of time. And I just wanted to throw in here, you can see zero debt. I love zero debt, and this allows you to see it. And they don't have any. They had some early on, and they've paid it off, and it's great. I used 11 and 14 for my projections. I didn't see anything that was really out of line, so I didn't change that any. And with 14% earnings growth, that would be a 21 at 1.5 times. I went a little bit below that, and then this forecast low is quite a bit below the low price, but I'm okay with being a little conservative there. And it comes out a 3.9 to 1 upside down, and it's got a very, very little, but a little bit of dividend for an 18% growth rate, or if you use the average, it's a 13%. So anyway, Skyworks has been doing great. To add some flesh to it, they used to be known as a supplier to Apple for the iPhones. They now provide a lot of chips for Samsung, but also I can't think of the Chinese company, Haiwa or something like that. Anyway, they really, yeah, thank you. So they've added those two customers by quite a bit, but they've also are getting to be very significant in the Internet of Things. So if your house is wired where you can do everything from your phone, like at work, you turn on the alarm, turn off the alarm, turn on lights, turn on the heat, they're very involved with that. So they've branched out quite a bit from Apple. Apple is still about 40% of their business, but it used to be 80%. So they've really broadened their base. So anyway, I think it's a great company. I still own it myself, and I recommend we buy it.
Okay, great.
Buy more of it.
Buy more. Okay, thank you, Roy. Any other questions for Roy? Do we have any questions for Roy? Okay, so there are 5 companies that, based on what I heard tonight, that they're in buy. Prestigious Brands, McKesson, did I say it correctly? Disney, Facebook, Skyworks. So now we're open to vote any motion to buy any of the stocks I just mentioned. No motions?
Well, I'll make a motion. We buy Skyworks.
1,000. How much?
Second.
1,000.
1,000.
We have several thousand we can spend, so we can buy
Okay.
more than one. But
Okay.
yeah, 1,000.
I'll make a motion for Facebook.
Okay, so one time, so the first motion is to buy $1,000 of Skyworks. Anyone second the motion?
Yes, I do.
You second? I'll second motion.
Yes.
Okay, so
I'd like to
open
make a motion to buy PBH.
okay.
One at a time.
One at a time. So the motion is to buy 1,000 of Skyworks, and motion second. Open for discussion.
How much money, how much cash do we have available?
As I recall, 4,000.
Okay.
Okay. So let's go to your email stock voting ballot and then to vote, cast your vote.
God damn.
Let's switch to mine.
Yeah, switch to yours.
Where is that?
There you go. You find it.
How do I get to the, oh, I have to go to the,
Yeah, you cast your vote first, yes, and
Yeah.
then you go.
where is it? Is it in the
Under
stock
stock
study?
study, yes. Actually,
It's this one?
even if you, yeah, it's a motion, it's a passed. It's a 88.9%. One no, I guess one no, and a 90% of is yes to buy. So we will buy $1,000 of Skyworks at the tomorrow open price. Okay, so the second motion is second motion is to buy how much? $1,000? Assume Penny first. Start. He said the Facebook first. 1,000. Penny.
Yes.
Okay, $1,000 of Facebook. Anyone is going to second the motion?
Do we have a criteria for how much stock, percentage stock we have in our portfolio?
What do you mean by that?
Is it no more than 15%? The stock has a position in our portfolio?
Oh, no more than 15%. Okay, I'm looking at it. Nothing is more than 15%. Nothing is more than 15%. The IPGP is only one is at the 14.5%.
Okay.
And Bank of Ozark is 11.3. Anything else is under 10.
Okay.
Oh, sorry. Facebook 10.6.
Okay.
So if you buy more of it, will that then put us over 15%?
Right. Just about, I think. Maybe not. I see what the question that Joanne has. You were saying that if there's any guidance that the one particular company no more than 15%.
And I think the reason for that is that if it takes a big hit, then it doesn't like totally destroy our portfolio.
Okay, so
we have a motion.
The motion is by $1,000 Facebook. I have not heard a second. Anyone second the motion?
Second.
I second.
Second. Okay. So open for discussion. And any questions on buying Facebook? Okay, now cast your vote. No, any questions? Go to the same email and cast your vote. Okay, sorry, I have to delete the results. I forgot. Okay, let me delete the results.
What was the result on Skyward?
I'm having a problem. It won't let me vote.
She hasn't cleared it yet.
I have not cleaned it. Sorry, I have not cleaned it yet. Hold on. I need to clean out the results first before I can. Hold
Yeah,
on.
I couldn't. Well, since you already voted.
Yes. Just a second. I'm doing it. Okay, go ahead. Okay, go ahead, cast your vote. What's the result?
Okay, wait a minute.
It's a two-step process for me, so I'm still doing it.
5 people respond, 6 respond. Henny still need to vote.
I did.
Henny
He
voted.
did. Henny voted, and so yeah, okay. So it passed the vote. The vote is about 67%. So the majority vote is 67%. So we're going to buy $1,000 of a Facebook at the open price tomorrow, and then also Bernard made a motion on buying Facebook. Oh wait, which one?
No, that was
PBH.
Facebook.
Oh, PBH. Sorry, PBH. So anyone second the motion? By PBH?
Tom? Is Tom muted?
No, I can't really recommend it. I mean, it's I think kind of high risk, and the price is depressed. I think it may pop back up, but long term, I don't know.
Okay.
Yeah, I agree with Tom.
So the motion died? No one
Yep,
second the
motion
motion.
died.
Motion died. Okay, motion died. So
Okay.
okay, any other motions? Any other motions? No motion. Okay.
I'll make a motion from McKesson.
I'll second that. Can I
Okay, open for
can I
discussion?
second my own stock?
I don't see why not.
Okay.
Okay.
I did a little research on the drug wholesalers, and they're all kind of facing a cloud where they think generic drug prices are going down, and the companies are going to be facing margin pressures. So the price of them all is down except for Bergen, which there's some acquisition on it. So the whole end, right? I think things can change, but there's a little bit of negative sentiment among the analysts as far as the industry currently.
But I think with McKesson, because they're so diversified, that if there is something going on with the generics, they're going to be able to withstand that.
They do a lot of things, but I think that the great majority of their income is from selling drugs. These other services don't. I don't have the numbers, but it's
Okay.
my impression that these other services are low dollar.
So you're not recommending it?
No, I was thinking about buying some myself. I decided not to.
Okay.
Wait, the drug? A generic drug. Okay. Sorry.
Okay.
Okay.
We should vote.
Okay, let's vote then. That's the discussion.
Did you clear it?
Did you clear it?
I did. Thank you, as you guys were talking. Okay. Okay. So we have $4,000. Okay. So we will have enough then. Whoa, it's tight. Oh. Okay, hold on. We need one more person.
Don't get in a rush. It takes people time to vote.
I know. I'm just looking. Sorry.
You're like New York, voting, casting, declaring the winner before Colorado and West has even voted.
No, I was just refreshing my screen. I just want to have a final. Yeah. Look. Okay.
Okay.
So anyway, that's a no then. Motion. Sorry, it did not pass.
So what's the vote?
No.
What's the?
Oh,
the majority 56 versus 44.
44 yes, 56 no. Okay.
Yeah.
By the way, Roy, I'm in the Toronto time zone, so that's the east.
Yeah.
So I don't know if we vote faster than you guys do in the west.
Let me put it this way: Google hates me.
Okay. All right. So okay, so that's it then. Roy, please purchase the vote for Skyworks,
Okay.
Facebook.
Yeah, Haney and I will do.
Yeah.
And actually, we've set up a meeting for Friday, but we'll base it on tomorrow's open.
Okay, great. So I'm going to adjourn the meeting first. Then I'm going to go back to ask questions, comments from our guests. Okay. All right.
I'm gonna for the meeting to adjourn. I'm gonna stop the recording.
Okay, and then I'm going to go on for the list, and then I'm going to